Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this is actually the first show of 2022, so Happy New Year to everybody that watches the show. But just to have a quick recap of where I left you before Christmas, it was with a reminder that despite the market wobbles that we were experiencing in December, that the uptrend in US stocks remained as it did in UK stocks. Meanwhile, Japanese equities were trending sideways while the UK pound continued to struggle, but it was giving a nice currency boost to any overseas holdings that you had in your portfolio. In the interim, I also said to watch the levels of 4,700 and 4,500 on the S&P 500 in America, and that a convincing move above 4,700 would likely spur a move higher in that stock market, while a move below 4,500 could see equity markets completely unravel. Now, similarly, the 1.4% level on the 10-year US Treasury yield was key, and if we tumbled below that, then equity markets were likely to come under pressure as investors flocked to bonds. So what's transpired since the last time I made this show? Well, true to form, the Santa rally came to town, continuing its amazing level of historic consistency. On the 23rd of December, the S&P 500 broke above that 4,700 level, and by the end of the year had breached 4,800, setting new all-time highs along the way. Technical analysis is great when you get it right, and it meant that the S&P 500 returned 4.36% in December alone, which is an incredible result. But the euphoria was actually matched globally, and it was even bettered in some regions. European stocks finished December up 5.47% as an example, and that's if you look at the Euro First 300. The FTSE 100, that rose by 4.6%, while the MSCI All Countries World Index rose by 3.6%. Even emerging markets and Asian equities, which were the laggards in December, rose 1.22% and 0.88% respectively, and that is as measured by the MSCI Emerging Markets Index and the MSCI All Countries Asia ex-Japan Index. Now, interestingly, also among the laggards was the tech-heavy Nasdaq 100, which finished December up 1.14%, and that was as bond yields started to creep up in the anticipation of policy tightening by the US Federal Reserve, the Fed. Now, the 10-year US Treasury yield rose back above 1.5%, which was good news for stocks, and it meant that we experienced the best Santa rally for the S&P 500 since the financial crisis, while in the UK, it was actually the best December since 2016. That just goes to show how good December actually was. And those who didn't keep their heads during December and panicked and sold out the markets during the bounce of market volatility actually obviously missed out in all of that growth. Now, interestingly, the winners and laggards were almost the exact reverse of the previous December in 2020, when the Nasdaq 100 and emerging markets finished up over 5%, while at the same time the Dow Jones, European stocks and the FTSE 100 lagged, but they still rallied 2.3% in December 2020. Now, that contrast in fortunes is down to what was driving markets this year versus what was driving markets last year. Now, into the year end of 2020, we had new hope surrounding the newly created vaccines, if you recall, alongside continued easy monetary policy from central banks around the world. But this year, with vaccines having already been rolled out globally, the focus was on the new Omicron variant and also on the tightening of monetary policy by global central banks, and in particular, the US Federal Reserve. Now, in the lead up to Christmas, I reiterated how more certainty on both of these themes, that's Omicron and that tightening of monetary policy, particularly in the US, would dictate much about how markets will move in 2022. So if we jump to 2022 now, no sooner had we begun January, we immediately had more clarity on both of those topics. So the consensus among health officials and governments seems to be moving towards that Omicron is of serious concern and highly contagious, but its hospitalisation rate is much lower than feared. And in the UK, for example, the government is clearly taking a wait-and-see approach, or you could call it just a do-nothing approach. And in addition, the US Federal Reserve released the minutes from its pre-Christmas monetary policy meeting on Wednesday. Now, some central banks, including the Bank of England, released their minutes at the same time as their decision, but not the Fed. Now, the immediate reaction to the Fed minutes was a violent one, in fact, and that was because they suggested that the Fed will likely taper its quantitative easing program, but also raise interest rates far faster than had been previously anticipated. And now, at the time of the release, European stock markets were closed, but US markets were open. And we immediately saw the Nasdaq 100 fall 3.3% for the day, while the S&P 500 finished down around 2%. And it was dragged lower by the exposure to tech stocks. And obviously, the Nasdaq 100 is tech heavy. Now, the more cyclically exposed Dow Jones fell just 1%. The market has only reacted more strongly to the release of Fed minutes on 3 occasions since 2007. And that gives the move this week some much needed context. And it's the combination of a more aggressive Fed, and that means higher rates, and the optimism over the path of Omicron, but also the pandemic in general, that is seen as a toxic combination for tech stocks. Now, just to remind you that higher rates are usually seen as bad for technology stock share prices because the future profits of these companies, and don't forget some of them have yet to become even profitable, are way off in the future. Now, when you have higher interest rates, that means when you discount those profits back to today, then that influences the price of these companies, their share prices, so how much people are willing to pay for those future earnings. So when interest rates are higher, that discount is greater, and it puts downward pressure on the share price of technology stocks. But not only that, because of the view about Omicron and the future of the pandemic, technology stocks no longer had the support of being seen as defensive plays during the pandemic. If you recall, there were a lot of work from home plays, and technology stocks did well. They almost were a defensive play at times during the pandemic, particularly in the early days. Well, obviously, that was removed with the idea that the pandemic might not be or maybe coming to an end. We have to wait and see on that. What it meant for technology stocks, it was back to fundamentals, and the valuation of these stocks was under scrutiny, and those future earnings were seen, less attractive than they were previously, and so the share prices tumbled. So that's why we've got this earthquake at the moment in technology stocks. We've well and truly gone back to the reflation trade, in fact, in a really aggressive way. So that's why we moved out of those technology stocks. And unsurprisingly, bond yields have spiked even higher, and the 10-year US Treasury yield exploded above 1.7%. And it'll be interesting to see if it breaks above the post-pandemic high of 1.778%. Now, it means that if you had a portfolio based around bonds and growth stocks, things like technology stocks, you will be probably licking your wounds a bit so far in 2022, although you would have enjoyed a decent 2021 with technology stocks. But if instead you had a low bond exposure and favoured inflation stocks such as financials, energy stocks, industrial names, then you will have fared pretty well in the opening days of 2022. Now, if you're an 80/20 investor member, go and have a look at the research piece on the funds for the reflation trade that I did earlier last year, and it will show you the assets that have previously performed well during such periods as we're having now and which have performed badly. But the question then becomes, can the reflation trade carry the market higher, or will the sell-off in technology stocks such as Apple spook investors and that bleed over into other areas of the market? Now, it's only the early days of 2022 and a lot is happening, but there are still plenty of questions that need to be answered. So, for example, is 2020 the year where we finally see the reflation trade take hold and we don't keep getting a rotation back in and out of reflation stocks into things that do well in a stagflationary environment, for example? That's what we saw a lot of in 2021. Has inflation already started to peak? And will we see a reversal? It's another question that needs answering. Will commodities continue their rebound from November's low? Or will the stubbornly strong US dollar spoil the recovery? Will growth stocks finally underperform value stocks and therefore give a chance for other global stock markets to outshine the US? I'm thinking about the FTSE 100, for example, in that particular scenario. And also, when do higher bond yields start to become a problem for stock markets? Now, all I can say is that if the start of 2022 is anything to go by, then this year is unlikely to be dull. So that is it for this week on Damien's Midweek Markets. I'll be back as normal next week. If you want to get in touch, you can do via email, damien@moneytothemasses.com is the email address. Twitter, money to the masses with a number 2. But you can also find us on TikTok, Instagram, Facebook, and most importantly of all, don't forget to subscribe to our YouTube channel.